Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site in Times Square, we have Chris Dearborn. He's the managing director on Nasdaq's market intelligence desk for our midday update. And Chris, so much for slow summer trade. There has been no shortage of headlines. Pretty interesting if you're a trader with some volatility back in the market, but despite a volatile week, we see stocks closing in the green for Friday.
It's a day-to-day vol that you're looking at. One day we're up 1.5%, another day we're down 3%, and you never really know what you're going to get here. But the only thing that you can be certain on is that the markets are not taking August off. The last 2 weeks have been extremely volatile, and even to the end of July. High volumes, big moves in the market, lots of news, though some people would say it's still the same old news, the macro headlines.
Well, you know what's so interesting too is when we saw pockets of volatility even last year and the year before, it would be the entire index that would move. At least with traders now, they have opportunities to pick sectors, to pick certain stocks that have that exposure to some of these headlines. So it's made for some pretty interesting trade this week.
The trading volumes have been unbelievable, right? We talk about it all the time. You've got above average trading volumes as putting the emphasis on traders getting involved in the market. You're averaging over almost 9 billion shares a day for the last 2 weeks. Today we're going to be light. Today it's going to be a summer Friday. Last Friday, even though we had the big move last Friday, was also a summer Friday, and Monday was a summer Friday. But yesterday, the day before, and Tuesday, high volumes. Yesterday almost touched 8 billion. We had north of 8 billion on Tuesday and Wednesday. That's telling you the people are in the markets and they are trading stocks.
All right, and same kind of issues and focus: tariffs, interest rates, global econ data. Consumer, though, that's the headline today.
The retail numbers yesterday were very good. Much better than a lot of people expected. And what you're seeing is that consumer strength has been playing into the markets for a long time. It's been a continued positive theme for the U.S., and it also bleeds right through to the U.S. GDP. We've talked about it before. We'll talk about it again going forward. 2/3 of consumer spend flows directly to U.S. GDP. And with that, you have the basis for things aren't so bad on certain levels. Right? You want to talk about the macro picture and how that's going to play out the corporate earnings. We're just winding up here, but we still got retail names coming through here. I mean, Walmart recently, Macy's. We want to see how that plays out for a lot of these companies, John Deere today. And with that, you're going to have individual items that are going to try to piece together this whole market. The overlaying theme is the U.S.-China issue. And if that trade barriers, the meetings do take place in September, again, one tweet, one comment, Hong Kong, right? Any of that plays into it. This whole thing could fall apart or it could take off. So it's a very fragile environment that we have here. Consumer has been a bright spot. And you have a number of companies making 52-week highs there, playing off them even in this down play. Starbucks, Pepsi's trading right there. McDonald's has been up there. You got a lot of companies that are doing very well that have high weightings within these indexes that are going to carry it forward. And when you have that, you have opportunity for traders to go back and forth.
All right, now speaking of tariffs and interest rates for the trading week ahead, President Trump, he's back in the White House, so I'm sure there's no shortage of headlines from that. And we also have Jackson Hole, so it's like everyone that's in the Fed is going to be in one spot. So I think traders are going to have to pay attention to macro.
It's a 100% chance that they're going to cut rates in the September meeting. The question is, what's going to come out of the August meeting out of Jackson Hole? And if there's commentary on weakness in the market, if there's concerns on things that are going into the market that impact the Fed and their decisions, that'll move the market significantly. Again, it's a 100% chance they're going to cut the rate. It's split between 2/3 of a quarter of a point, which is already baked in. We talked about that last time, or a third that's looking for a 0.5 point cut. What's that going to do to the yield going forward? We've normalized. We had the 210 cross. We talked about very high telegraphed yesterday. It's normalized about a 6 basis point differential right now. And you had the 30-year dip briefly below 2%. Those headlines could move the markets in disastrous ways or very positive ways. And if that crossover happens again based off of comments here, the bid up on the treasuries is going to be significant. That could destroy this market right now, especially on the equity side, because it's a very fragile environment. And headlines are really where it's being driven, even though the underlying consumer information is good. Yes, we're in a global slowing economy, and yes, the U.S. is slowing slightly, but the U.S. is still strong.
Yeah, but even if you get those headlines and you see the yields move in either direction, 90 minutes of a move, and Steve and I spoke about this yesterday, 90 minutes of a move versus 90 days, 6 months. That's the difference.
It's headline risk. People are reacting to the headline instead of looking at the broader picture. And I think that's one of the other things that you're getting traders coming into the market who maybe have a little bit more longer term, and they're looking to buy certain dips to get a good price into the certain equities. And you're getting some really good stocks that are on sale And you still have headline risk. You had headline risk yesterday, still playing out right now.
Right.
You're still going to be open to that. But the dips, how much is the dip going to happen? The S&P retail sector, sub-index sector, is trading at the bottom of support, and you're looking at a 10 to 12-year support. If that support breaks, what's that going to do to the overall consumer index, which is the broader base index, one of the 11 main S&P 500 indexes? Will that drag it down? That's been a sign of strength here. So are the traders involved on a longer-term basis buying stocks on the dip and holding them, or they're just trading them intraday or for the week for that matter?
Yeah, well, I mean, but if you're a longer-term retail investor and you're investing in your 401k and you can use, without even thinking about it, because this happens automatically, acquiring shares when stocks have been depressed, this is kind of what longer-termism and compounding means. So it could be a good opportunity if you look at it like that. As always, thank you for joining me.
Thank you, Jill.
We'll be back in touch on Monday. Thanks for joining us throughout the week on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.